Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, September 23rd, 2010. Let's start with a look at the euro-dollar pair, where we saw the euro fall against the dollar as well as the yen after a market-wide realization that the prospects for growth in the eurozone remain dim and its problems widespread. Overnight, data showed that growth in Europe's services and manufacturing industries weakened more than economists forecast in September, adding to evidence the recovery in the region may be losing steam. We see that the pair fell from the 1.34 area prior to those reports down to 1.33 in New York trading. We did have some US data, including weekly jobless claims, that did come in weaker than expected, so that helped the euro to recoup some of its losses, but overall, it does remain close to its lows for the day. If we take a look at a 4-hour view of the pair, we see that we retest our highs from early August, which had acted as resistance during that rally, so perhaps it may now be turning to support, so this is a very important level to watch. However, if we fall below that level, we may try to retrace more of this very strong 2-week rally in the euro against the dollar, which came as a result of first speculation of more quantitative easing by the Fed, and then confirmation of that following the dovish Fed statement that we had this week. After a recent patch of strong Eurozone data suggesting the region would defy the slowing occurring in the US and elsewhere, the Eurozone appears to have gotten a dose of reality. Both the manufacturing and services PMIs came in at 53.6 for the preliminary reading for September. The PMIs were expected to rise 54.6 and 55.9 respectively. Growth in Europe is slowing as the global economy cools, and austerity measures aimed at reducing budget deficits and reining in borrowing costs undermine the recovery. Ratcheting up the worry over the economy was news that Ireland's economy shrank by 1.2% in the second quarter, which sent yields on 10-year Irish bonds to fresh record highs, as well as the cost of insuring Irish debt to record highs. Taking a look at the euro against the yen, here too we see a rather sharp decline after we tested the 113.40 level for the second time this week, but were unable to move above that level. Instead, we fell down to around 112.15, testing an upward sloping level of support in this pair that had been set up recently, connecting our two most recent lows. If we move below this trend line, we could see further retracement of the rally in this pair that we had seen as a result of the Bank of Japan intervention last week. However, currently we do seem to be confined within a bit of an upward sloping channel in the pair, but we do have this horizontal resistance setting up at 113.40. Turning to US data, as I mentioned, we had weekly jobless claims that were weaker than expected as they increased by 12,000 to 465,000 in the week ended September 18th. That figure disappointed forecast and is a sign that companies remain cautious about hiring as economic growth slows. That also breaks the recent trend we've had where 2 weeks in a row we've seen claims around the 450,000 level. However, we did have a better than expected report from the US housing market as existing home sales increased 7.6% to an annual rate of 4.13 million units, slightly better than the 7.1% gain to 4.10 million expected. However, that did follow the 27% plunge in existing home sales we saw in July, which put the series at a record low. We did also have some good news on inventories. They decreased by 0.6% at the end of August to a 3.9 million available pace. That is a 11.6 month supply at the current sales pace, down from the 12-month supply we had seen in July. Taking a look at the dollar yen, we see that it rallied a bit overnight, but then fell back down in European trading and set a low following the weekly jobless claims at around 84.30. That comes close to testing our earlier resistance last week prior to the Bank of Japan and the Ministry of Finance intervention that we saw midweek. So we'll see if this level holds as support. However, more likely we might see this pair continue to move downward until we see some kind of action from the Bank of Japan. Now, they waited till the pair hit the 83 level before intervening last time, so we may target that level until the Bank of Japan rears its head in the market yet again. Keeping with the theme of yen pairs, let's take a look at the Australian dollar versus the yen, which we saw fall rather sharply overnight, coinciding with the weaker European data. We fell to a 1-week low in the pair. This pair has set out a rather important resistance at around the 81.30 level, a level we've tested 3 times in the previous 5 trading sessions, and we've been unable to move above. Here too, we may see the pair trying to retest a old level of resistance and turn it into support at around the 79.35 level, which was our level of resistance in late July, early August, that we broke above in last week's trading as a result of the intervention from the Bank of Japan. So the market may want to target that level and see if it will act as support now. In a look at the New Zealand dollar US dollar, here we see a very sharp slide at the beginning of the New Zealand session, as we did have New Zealand releasing its GDP for the second quarter, and it came in weaker than expected. And following that slide, we saw another round of selling or movement in favor of the greenback on the wake of the Eurozone data, though we did see a support set up at 0.7260 and a little bit of a rally in the New York morning trading session. The moves in the overnight session undid most of the gains we saw in the New Zealand dollar following the Fed statement, which came 2 sessions ago, and in the wake of that yesterday. Taking a look at that New Zealand release, we saw the economy expanding at 0.2% pace in the second quarter after it expanded a downwardly revised 0.5% in the first quarter. Expectations, however, had been for a much larger 0.8% gain. Growth was weighed down by a decline in manufacturing activity. While the New Zealand economy continues to recover, growth remains tepid, and the GDP data today is unlikely to change the view that the Reserve Bank of New Zealand will keep its official cash rate on hold at 3% for the remainder of this year. This weaker than expected report is in sharp contrast to the growth we've seen in the Australian economy during the second quarter, so that may put extra pressure on the New Zealand dollar. Speaking of Australia, let's take a look at the Aussie against the US dollar, and here too we see the Aussie sliding during the European session in the wake of the Eurozone data, but in the New York session we see it rallying rather strongly after finding support at 0.9465, so it cut more than half of that overnight decline already. US stocks, which had opened lower following the weaker jobless claims, have shed a good bulk of their losses as the existing home sales data was a bit better than expected, and we had the Conference Board leading index posting a better than expected figure. So we'll see if we have a bit of switch from risk aversion in the overnight trading to a little bit of risk appetite, at least in terms of higher yielders like the Australian dollar in the New York trading session. So that's the story with our market highlights and data from today. Let's now move on to the fundamental docket for Friday's global session. Overnight, we get some releases from Germany, including import prices and the IFO business climate, as well as the Swiss National Bank quarterly bulletin. Tomorrow in the US, we get a look at manufacturing with durable goods orders, as well as the new home sales release. Also tomorrow, Fed Chairman Bernanke is due to give a speech titled Implications of the Financial Crisis for Economics, but it is coming late in the New York afternoon and will not have an impact on currency markets. And that wraps up today's video recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.